So I'm from Mortgage HQ. My name is Blandon. And so I wanted to start off with this right here. So you guys are not allowed to Google this, but I want you guys to guess how much this property sold recently. So this one bought in November for $640,000. This one sold recently in May for $1.6 million. Now, this is actually not just a normal property, because what we are seeing is that this is a trend. This is a trend that we have been seeing in the market, and that is property with good development potential sell for a very good price. And if you try to analyze their capital gains, it would be through the roof. So the average market return for a normal property is around 7% on capital gains, but you're in the double digits for anything with a good development potential. So how do we identify these opportunities, and why is it so good? So actually, Al has touched on a lot of the points on the land that are actually really good for you guys to try and aim for. But the reason why something like this sold for this much, it's the government's fault as well. So let me tell you why. Because previously, when the government used to have the rule where you can have buy new builds for with just a 5% deposit, and you could potentially just buy something at $650K, and you only have to put in a 10% deposit, and then you also get some government subsidies as well. And what the government actually did was, after the changes with the tax law, they actually implemented a new sales figure for the new build. So they're basically giving you more money to buy new builds, and there wasn't enough thought put into that new ruling. So basically, what happens is the developers didn't start building more fancier houses. All they did was take the same piece of land and just sold the same house for another 50K or 100K more, because the government decided to bump up that bracket. So that's why there was an influx of the land value going up. And of course, secondly, it's just non-stop money printing that we've seen all over the world at the moment. But going back to this piece of land, what is the opportunity here? So this is something you can do on this piece of land, is sort of build 8 units quite easily. If you want to build 3-story as well, you can build 3-story. But this is the sort of bread and butter for a lot of medium-sized developers, sort of that 2-story terrace house with the car park outside. And these are selling really well. It's getting a lot of people in first home. It's actually a good thing, because they sort of sell within that sort of 700, 800K range now, depending on what area you're in. So, yeah, I mean, if you look at the rendering, it's quite nice on what you can potentially build on these kind of sites. My presentation today, we're going to cover 3 things. The why, and it's looking at the opportunity. What are the returns in sort of developments? Why are people doing it? And then, what are we investing in, and what are the risks? Because you really want to understand why, what might go wrong, and how could you mitigate those risks as much as possible. And then thirdly, how you can get started. Okay, so the first thing is I just want to give you guys this concept of the mortgage life cycle. So if you guys have been on our website, you'll have seen this concept here. This is the goal for everybody in here. If you guys are wanting to retire at some point, we have the same common goal. And this is trying to build our wealth to a point where we can stop working and still enjoy the same lifestyle. So this is the point where we've got enough money or wealth for us to stop working and still enjoy life. And so there are 3 stages in the mortgage life cycle. So stage 1 is when you have your first mortgage, and this is your first home, and what your goal is actually to reduce your debt, and so you can build up equity as quickly as possible. Okay, and once you have built up the equity, the second stage is to use the equity in your property, and you want to expand your investments. You want to be probably not the best word, but you want to make sure that you're putting your money in growth funds or growth investments. And then the third one is, once you have built up the equity, it's all about optimizing. So optimizing is actually trying to get the maximum out of your investments that you have built up. the cash flow it's actually going to allow you to stop working and enjoy the same lifestyle. So what does that look like on paper? So traditionally, if you understood how property investment works, is basically you buy a house and you pay down your mortgage to a point where potentially you've got a bit of equity in here. So you could use this equity, okay, and you put it down as a deposit, and then you use that equity to buy another property, and then now you can get a little bit more equity out of this and equity out of this one. Then you put this down as a deposit, and you buy another one, and then you buy another one, and so on. And then once you hold sort of for 10, 15 years, what you can then do is actually sell some of these and then cash out. And that's your retirement funds right there. Or you could just hold a couple for rental income. How does that actually differ if you're a property developer? So instead of selling, so the step that you would do is, if you want to buy a land bank, you would still have these two houses. What you would do is then you might sell one, and then you want to bulldoze this house and you want to rebuild, and you might build a block of units like this, and so you can retire on like 4 or 5 rental income. So you get a lot more cash flow out of the properties that you have built up. And this is something that is very common for a lot of our clients at MHQ. So the second thing that we want to just sort of go over is the 5 C's of properties, because development is not for everyone, and it's trying to understand if it's the right thing for you guys. Because you think about it, the property development is like the gold rush, right? The gold rush, the people that make the most money is the people selling the shovels, right? The consultants, the due diligence, all of the consultants are making the most money. Not everybody is making good money in development. So we have to understand what is a good development, and how do we make sure we mitigate our risk. So there are 3 C's that we need to understand. So first of all, in a property, what do you get, right? What are you trying to get from a property? First of all is cash flow, okay? So cash flow is the most important thing in a property investment that is different from everything else, right? Because you've got the rental income coming in, and that allows you to pay for your mortgage. And what you find, interestingly enough, is that cash flow has an inverse relationship with capital gains. So what that means is, when cash flow is low, capital gains tends to be high. So can you guys think of an area that has high capital gains but lower cash flow in comparison to the value of their property? It would, if you guys are in Auckland, central Auckland, areas like Remuera, you're going to get a lot. Epsom, that's a good one. So what happens is, if cash flow is high, capital gains is low. Now, the third most important C is what we're going to talk about today, and that is the capital improvements. Capital improvement is where you can actually create more cash flow or create capital gains. Effectively, if you could develop the property further, you would expand this, right? You would actually increase the bar, not in the middle, but actually you would create new cash flow and a new equilibrium on the capital gains as well. So, and if you look on a radar chart, the 5 C's, we've got cash flow, we've got the rents, we've got capital gains, we've got the capital improvement that we just talked about. But the 2 other things that's really important to understand before you decide whether or not development is for you is the convenience, how hard it is or how easy it is, and the capacity required. Now, I'm not saying, you have to be ultra rich to be a developer, but I would say capacity is on the higher side. You want to start with a stronger financial position where you have a bit more cash and a bit more borrowing power. So I would rate probably on the slightly higher side. Capital improvement value is probably maxed out. Capital gains, traditionally, if you look at the residential market, land banks are the highest capital growth. And then you also have your cash flow, which is on the lower side. And so convenience is not convenient at all. You are needing to learn a lot, I'm going to tell you, with developments, or you can easily make mistakes and lose a lot of money. And for a lot of people, I can tell you right now, for most mom and dads, they shouldn't be developing. They should just sell that piece of land just for someone else and just cash out and put that money somewhere else in a safer investment. So if you fill this out, this is sort of how development looks like. I want to explain the second concept with you. After you understand the 5 C's, there are actually always 4 prices that you can pay for a property. So the first idea is because if you're an investor, you really want to buy undervalued. That's the most simple concept, is to buy a property undervalued, under market value. Okay, so MV stands for market value. So if you buy undervalued, you gain instant liquidity. This is your profit right here. Okay, there's a second value. This is called under renovation value. Okay, so that means in this particular area, if you renovated the place, you would actually get the top end of the market price. So here you might pay a slightly you might pay around the same price, but you could improve the value. You could add some capital in, you can spend some money, and you would make this equity right here. This is your profit. Okay, so the third value that you can pay on a property is actually what we call a mini improvement value. So improvement value. So like, let's say if you've got a backyard that you could just maybe put a minor dwelling, or perhaps it's a house upstairs, downstairs, very clearly, you can maybe put a firewall in between to make it a legal home and income. So this house, you can afford to pay a slightly higher price because it's got a bit of development potential. So now you're sort of paying higher than what other people are paying, and you can spend the money to build a minor dwelling or whatever you might want to do, and this is your profit here. Now, the fourth value that's really important to understand is the development value. So if you are an astute investor, this is probably the most important one now, because this is a market where the development value will affect a certain the price of a property significantly, because what that one will look like is sort of like this, right? And so developers are going to look at how much margin they want. Usually it'll be like that 25%, 20 to 25% mark, okay? And then they're going to try to calculate how much does it cost to build, okay? So they might be like, okay, it's going to cost me to sort of build maybe for 2.5 million for 6 townhouses, and then this is the price that I'm able to pay. So these are the 4 values that you need to understand. And as an astute investor, you're constantly trying to find properties where you could buy at this value, but you can get this upside here, because that's the ideal scenario. But that's very hard to achieve. But there are properties that I've seen our clients able to execute on and sort of buy at market value and get the upside as well. But knowing how to do the numbers are going to be the most important. And I'm going to show you a bit of that today in this presentation. Okay, so we've got 3 pros and 3 cons for the developments, and I'm going to just list them out really quickly. So first of all is, we already talked about it, the capital gains is off the charts with developments, and because it's got that long-term development potential, it's going to allow you to achieve the maximum capital gains. The second one is the capital improvement, and something I learned about myself running a business is, like, I didn't actually know that I'm a control freak, but my business partner would say that, you know, like, I micromanage a lot of parts of the business, which is something I'm learning. But that's why I like developments, because you are in control of the future capital and the future sort of cash flow. You can actually create those yourself, and being able to control that is something that I truly love about developments. And then the third thing that you have is liquidity. So meaning that if you got a good piece of land, it should be very easy for you to sell that property and just find a buyer for it any time. And it's almost like holding cash. The cons of property, as we talked about it, is the cash flow. You're going to have lower cash flow. And then we also got convenience, which is there's actually a lot of stuff that you should be learning about development, or it could easily, sort of take off your margin at the top really, really easily. And then lastly is the capacity. So I do recommend majority of people who do developments is sort of in a higher cash flow position. And so if you look on a chart like this, if you compare your current situation, are you in a high cash flow, high equity position? Then I think development is, or land banks is something that you could potentially consider. Okay, but I'm not saying that you can't do it the other way, but it would mean that you probably need to put in a lot more knowledge or a lot of time to really understand so that you can convince other people to go on a deal with you. Excuse me. Okay, so second question we have is, what are the risks and how can they be mitigated? Okay, so if you guys know this guy, Uncle G, Grant Cardone, he is, I mean, there's a lot of stuff that I don't like about Grant Cardone, but there's also a lot, there's just so much that we need to learn from this guy, because he has taken the property game to a whole new level, utilizing social media. You know, he's just a big syndication. He's just doing big deals and getting a lot of investor money piled in. And he's taking the investor game to a whole new level. And he said this thing, right? And it's true. It's true, because this is the same way the bank thinks. Because if you're thinking about how to finance a property, you need to not worry about the money at all, but worry about the deal. Not worry about the money, but worry about the deal. And I'm going to explain exactly what this means in a second. So just keep that in mind. Don't worry about the money, worry about the deal, okay? So remember, there are 4 values that we're exploring in each property, okay? So you've got under market value, okay? And you've got under renovated value. You potentially might pay a slightly higher price or lower price, depending on how much renovations you can do. And then the under improvement value, this is, you know, your mini development. And then the fourth one is your under development value. So remember, the most important thing is when we zoom in is it's all about your margin, your profit margin, because if you do your numbers correctly and you've got a good profit margin in any deal, there is no reason why you cannot get finance or investors to go in on a deal with you. It's kind of like saying, hey, Blandon, I've done my numbers. There's 150K on the table. You're in a strong financial position. You can borrow the money. Just let me have 30%. You finance the deal, I'll have 30% equity. Done deal. You know, you're bringing me money, you're bringing the investor money, someone will do the deal with you for sure. So it's all about looking at that profit margin, okay? So margin is something that I'm going to keep talking about throughout the presentation, okay? So there are 3 costs in a development, okay? The 3 major costs, and you guys probably notice: cost of acquisition, and then the second one is your cost of construction and infrastructure, or let's just say the development, just cost of your development. And the third one is your margins, okay? These are the 3 most important figures for you to get financing from the bank or to get investors, okay? And getting these numbers correct, just like sort of Al mentioned earlier, making sure that you do your numbers correctly, that's how you're going to be able to get finance. Okay, so there are important research that you need to do, because the end value, which is your margin, and your acquisition price, these here, you have to rely on CMA, right? Comparable market analysis, understanding what new builds are selling for in that particular area. You're going to find a pattern. You need to find those patterns, understand it really well, and then also acquisition price, you know, sort of be a fanatic in certain suburbs and really understand what is going on in the market. And, you know, another way is obviously having a trusted real estate agent. Unless you're doing a lot of deals with them, they probably don't have time for you, because most real estate agents just want to sell properties. So you have to be quite active if you really want to you know, sort of befriend a real estate agent, or you know, you pay for their time, because Al has a lot of understanding and knowledge about real estate, and there's actually a lot we can learn from a real estate agent. But it's just often, you know, if there's no deal for them, it's very hard. So it's better to just pay them for their time. Okay, so you have to become a suburb expert. Okay, so this is actual spreadsheet that I personally use, and I'm actively looking at deals as well. And this is a very simple sheet that I put together just to pay attention to how much properties are selling for in that particular area. I drop down of everything that is sort of a larger land, and then trying to understand how many square meter things are selling. And then another one that is very important is trying to understand what's the max building coverage. So max building coverage is basically because properties are in different zonings, and if they're in different zoning, the amount of building you can put on a piece of land is going to change. So if you're going to pay the same price for mixed housing suburban, which is you can build 2-story, or a little bit more for a mixed housing urban zone where you can build 3-story, it would be a no-brainer to take the mixed housing urban zone one for just a little bit more. So paying attention to the building coverage is very important. Okay, so this one here is the second part of the cost. We talked about the end value and the acquisition costs. This one here is all about the construction and civil. And there's actually a cheat to getting the construction and civil costs accurately, conservatively, without making as much mistakes as trying to guess and trying to hassle all kinds of builders. You don't even have any contracts for them, and trying to hassle them what price it is. They're so busy, they're just not going to spend the time with you. But if you're willing, you can actually get all of this information off a QS by paying them a fee to do a QS report on a certain build. So to give you an example, if you just pay them and give them a particular property, they can produce a report like this to tell you exactly how much it would cost to build that particular property. So if you want to be really, really thorough, you want to give them different types of properties. You might end up spending 20 grand, but if you want to make millions in developments, what is 20 grand, right? So you want to send them a few different type of builds, maybe terrace housing, maybe something that's on a floodplain, which is basically the foundation that's going to cost you a lot more. Just understanding what's some rough figures if you had maybe floodplains, and then also on the slopey site, having bridging over the stormwater and wastewater. And look, if you guys are still here at the end of this presentation and you guys are interested, I'm more than happy to just go through the numbers on a real example. But yeah, this is all about investing and learning, and don't be afraid to spend some money and try and learn from the consultants around you. Okay, so that's why I say don't worry about the money, worry about the deal, because the bank thinks the same way. Because development finance is actually a lot simpler than trying to do a fund proposal for even an investment property, because the margin and whether or not there is enough margin for the bank, that's when they would allow you to borrow the money. So if we look at the three things again, there are sort of three parts to a development. So to explain this, you've got your margin again, okay, and then you've got your owner's equity. So this is the capital that you have in the property, and then you've got the development cost. This is the development cost. Now this is where people fall short the most, right? Because there's a big development, but they don't actually have enough equity. So the bank don't actually want to lend them. Or even if they have enough equity, they don't have enough documentation, like feasibility reports and sort of all the right consulting reports around them, so that they can convince the bank they got a good team to do the development for them. So that's really important. But the basics of development funding is that they can actually lend up to, most second-tier lenders will be able to give you up to 60 to 65% of the completion value. So this is what the project is worth at the end, excluding the GST. They can lend you up to 60 to 65%. And if you're at the main bank, they're more conservative, so you're going to be able to borrow less money from them, and there's also actually more reports that you have to do. But the interest rate is going to be slightly lower, and they are more likely to lend you 70% to 75% of the total cost of the property. So in this situation, that means this guy might be slightly short. So like, let's say we're working on 75%, we probably need to find some more capital. Okay. And if there is enough margin, this is the thing, right? Because you can actually find investors to fill the difference. And when I say investors, it doesn't mean you get people from the public, but if you have done your numbers really well, it should be very easy for you to get more capital injection from a JV, perhaps through friends, perhaps through family, because it's just all about splitting some of that margin, right? Because you've got all that margin sitting in there. Don't take everything yourself. Give some away. At least everyone make money together. And this is something that we can actually help you with and see sort of what you could potentially do on a particular project. Okay, so and with developments, the interesting thing is, someone I saw in the chat talking about build to hold. Now, build to hold is actually really simple as well, because it's all about servicing. So whether or not you can service the loan, let's say if you were to build 8 properties like this, and then they do the stress test. If you don't know how the servicing calculator works, you can check out our YouTube, but all properties are tested on a 6%, right, interest rate. So, most projects in Auckland might give you like 4 to 5% gross yield on the cost. Okay, so that's not enough to service 6%, and you're going to run out of servicing really quickly. Okay, so 6% is the stress test. And what happens is your return is only 4 to 5% cash flow, but the bank only takes into 75% of that. So really quickly, you can see there's a discrepancy between the two, and the bank's not going to allow you to hold everything. So it's just trying to plan ahead on how many of these you potentially need to sell. So like, let's say if this is 8 lot, maybe your income is allowing you to, maybe just keep the 2 over here, and you have to sell all of these. So it's just trying to pre-plan well ahead in advance on what that servicing looks like in the end position, on whether or not you can keep these property, and then how many you might have to sell. So, and if you want to learn how to do that, this is something that we could give you a consultation on. And obviously this is not, it's not really profitable for us. So we do have a program. If you join a property accelerator, at the moment we will do a free consulting session on the development stuff as well, so that you can at least have some feasibility numbers, because this is something that you'll need to then take to your consultants, like your civil engineer, your architect, your planner, and your construction manager. So just once you have the numbers, then you know roughly how much you can sort of budget for everything. If you want to learn exactly how you can set up your next 3 property purchase, do check out the Stage 2 Masterclass in the description below. Until the next video, I'll see you again.